Hi, I'm Mike Coe, and I'm addressing your open interest. If you have a question or a comment and you would like me to address or answer it, please send me a tweet at Michael_Coe, and I will try to answer it. Okay, so we got this question, and I think it's an interesting one. Rick asks, I'd like to know why equity options are still only traded as 100 shares per option, especially in light of stocks not splitting. Example, Amazon, greater than $3,000 per share. Okay, so this is a good question, and you are not the first one to ask it. So the issue that we have here is that most stocks and ETFs, indeed most index options, have a multiplier of 100. So for example, if you are looking at Microsoft, an option contract will represent typically 100 shares of the underlying. So whenever you see the premium amount, so if you see an option that's trading for $5, the actual amount of premium involved is actually $500 because the premium is expressed per share. Now it's important to note that corporate actions can actually adjust the number of shares that an existing options contract will represent. So if there is a stock split and you had an options contract for 100 shares and the stock splits 2-for-1, the options contract you hold will be adjusted to reflect that split and will now represent 200 shares. I think the bigger question, though, is that options premiums are also a function of the underlying stock price, all else equal. Okay, so by way of example, if I have a $50 stock and I'm looking at a 1-month at-the-money call option, and that at-the-money call option, let's say for the sake of argument, costs $4. Well, if that stock was $100, same amount of time to expiration, same at-the-money strike, so the 100 strike, same implied volatility, everything the same, that premium is going to be twice as high. So rather than $4 per share or $400 in premium, it's now going to be $8 per share or $800 in premium. So it's been asked, when stock prices get exceptionally high because the stock has not split, and in this case the viewer is talking about Amazon, then the options premiums themselves can also get quite high. And that means that the denominations, the minimum trade size that you can engage in, might involve a decent amount of money. So if you're looking at a $45 option with a 100 share multiplier, each options contract is $4,500 in premium. So this was an issue that the industry actually recognized quite some time ago, more than a decade ago. And in 2013, they actually tried to do something about it with the issuance of mini options. The thing is that, I mean, there's a lot of options available. It's sometimes hard for people to keep track. And there just wasn't a whole lot of uptake on this. And actually, it will be interesting to note that in some cases, the options activity that was seen in some of these high dollar stocks was a function of the fact that the stock price was so high. So when Apple was trading at a high level pre-split, there was more options activity resulting from that because people were looking for a lower cost of entry. Now, I would point out that if you're controlling 100 shares of a high dollar stock, your net exposure is quite great. So this was a simple circumstance where I think there is some demand for smaller options contracts on these higher dollar stocks. But unfortunately, when this was tried, and Amazon was actually one of the stocks that it was tried on, the uptake in these smaller contracts simply wasn't sufficient to justify continuing to list and make markets in them. So you are dealing with an issue that other people have recognized. Here's something you can do, though, instead. So rather than just going out and, say, buying an at-the-money call option if you're making a bullish bet or something like that, try to focus on the use of spreads. So we're talking about vertical call spreads, vertical put spreads. This could apply whether you're looking at debit spreads or credit spreads. You can also consider things like butterflies, things like that. These are the kinds of structures where you can mitigate the amount of premium. It's not a perfect solution to the problem you describe, but it is a way that you can try to think about using options more creatively to address situations where you find that the premium involved, the risk involved, is a little bit too high. So I hope that helps you. If you have a question, please send me a tweet at Michael_co, and I will try to answer it for you. Thanks. If you liked the content, please consider subscribing to the Open Interest YouTube channel. That's youtube.com/open interest. And of course, you can also follow or tweet me at Michael_co, or go to our website, www.openinterest.pro. Thanks for watching.